Welcome back. In this video, we'll look at 5 reasons that stop you from holding your investments for longer periods. However, before we get into that, it's time for me to remind you to press the like button and subscribe to the channel, and also press the notification button so that you are notified when I release a new video. With that out of the way, let's get started. Reason number 1, lack of conviction. Ideas can be borrowed, but conviction should be backed by work. When I say work, I mean doing your own analysis, studying the company, the industry, the current affairs, and looking at the technical charts in order to form a comprehensive view on the outlook of the company. This is just the first step though. Once you invest in an idea, you need to continue to monitor future developments, and only then can your conviction stay strong. Reason number 2, lack of cash flow. Here we are not talking about the company's cash flow. Nope. Here we are talking about your cash flow. It's true that everyone comes to the stock market for making money, and the only way to do it is by investing your money. You are more likely to be able to hold on to your investments for longer periods if you have sufficient cash flows to meet your other needs. If not, you are likely to find an excuse to exit a great investment because you need the money. Reason number 3, experts, TV and news. Now we live in the information age. For the average investor today, there is also no lack of experts to share their opinions. An investor with weak conviction would probably heed more to what he watches on TV rather than his own understanding. Then there is the constant barrage of news and the ability to interpret the news in right context. Most of you would think that a good news means the price should go up and a bad news means the price should go down. However, once you have spent sufficient time in the market, you would realize that this is simply not true. The reaction of the stock price to a news is not a matter of whether the news is good or bad. Rather, it's a function of when the news hits the market. This is to say that depending on the phase in which the stock price is currently in, the market may react differently or to a different extent to similar news. For example, a stock that is in a strong uptrend is likely to ignore bad news, especially minor ones, and it's going to amplify positive moves on good news. Similarly, a stock that has fallen substantially may stop creating new lows as more bad news flows in. This is because the price action is about to turn positive, and subsequently the news flow may also change. Then you may find that a stock may stop reacting to news as more positive news flows in. This is because the uptrend may have already run the course, and the stock may have entered a distribution phase as a new downtrend may be about to emerge. I deal with this complexity using Elliott wave theory, as by using Elliott waves it becomes easy to recognize the phase in which prices are currently moving. Now if you would like to learn more about Elliott wave theory, I have left a link to my course on this topic in the description below. Reason number 4, fear of missing out. The fear of missing out on other opportunities is very real. Any stock cannot go up continuously, so there would be weeks and months where there is a strong uptrend in the stock, and then there may be many more months when the stock does not make substantial progress or maybe even declines quite a bit. In periods like these, when the prices are consolidating, it is likely that you may try to exit the stock because you learn about some other opportunities. This is more likely to be true if you don't have a strong personal cash flow, because otherwise you won't need to sell a performing stock just to buy another stock. Reason number 5, habits. Most retail investors have a habit of holding on to losing investments and booking profits early. This is because most investors don't form a view on the price for long-term investments. There is tendency to hold on in the hope that the prices will rise, but because their experience is dominated by losing money, they tend to use these minor rise in prices to book profits. The key here is to make sure you have a way to form views on the price of the stock over the long term. Here too, I find that Elliott wave theory is of great help. With this, we have come to the end of this video. I hope you liked it, and if you did, Please remember to like the video and subscribe to the channel. Thank you for logging in.